Network. Before we get into today's show, there are a few things we have to go over. Firstly, what you're about to hear and see is limited to general information only. It's not personal financial advice like you'd get from a financial planner. Also, it's important to remember that past performance is not indicative of future performance. That means that anything that's happened in the past, or we say today, is not necessarily going to reflect what happens in the future. Lastly, please consider that any of the guests or myself featuring on this program may have a financial interest in some of the products or shares mentioned. That's enough from me. I hope you enjoyed today's program. Raymond, Jang, welcome to this episode of the Australian Investors Podcast, mate.
Thanks, Owen. It's good to be back and to see your friendly face again on the screen.
Yes, it is, mate. It is indeed. Today we're going to be talking about Lovisa Holdings, which is on the ASX under the ticker symbol LOV, like love, but without the E. We thought we'd sit down and we'd talk about this company because it's a fascinating retailer. Just off air, this is going to be just off air. We were talking how we've spent a bit of time on this. I spent a bit of time on this morning. You've spent a bit of time over the last week or so on it. We're just talking about kind of like what makes this business so special. It's kind of secret sauce. And I think many people will be surprised by how interesting this business is from like an economics perspective once we get into it. But maybe we can start off with just you, mate. How are you going with all this market volatility? How have you found it?
Yeah, it's been quite challenging, but also exciting at the same time because we're seeing a lot of the quality names actually, dropping in price, which is exciting. But there is a lot of pessimism across a lot of articles and general media. So it's a bit scary at the same time, but I think it's important to keep a level head. How about yourself?
Yeah, I feel like keeping a level head is pretty hard right now compared to other times. But it's interesting because a lot of the even the really high quality companies that maybe weren't like grossly overvalued is still kind of finding a flaw in this new market. So I mean, there are companies that were clearly overvalued. For example, a company that I own, which is Pro Medicus, which you know really well, that has been falling. And this is the best performing stock over the past 10 years on the Australian market. And it's probably fair enough because the company was really expensive. But then there are other businesses which I've found that seem to be cheap, but really are still kind of getting sucked up into the volatility. So I think that's where the opportunity lies for us. But I mean, nonetheless, it's been pretty hairy. One of the companies that we're going to talk today is Lovisa. And this company has also been kind of involved in this volatility, maybe for different reasons, which we'll get into. But it's one of those really high quality retailers on the ASX. What we're going to do is Raymond's going to provide a bit of a history on the industry and kind of like where Lovisa sits. And then we're going to have a bit of a chit chat about the business. And I'm going to go through my investment checklist for listeners. So, mate, this episode, by the way, is powered by SelfWealth, our newest sponsor on the Australian Investors Podcast. You can head to selfwealth.com.au, $9.50 for a trade, buy or sell, trade Aussie, US, and Hong Kong listed stocks there. So, mate, maybe for those of people that are watching on YouTube, I'll flick on my screen here and we can see Lovisa just here. Why don't we just kick off with, I don't know, just a bit of the industry, where Lovisa sits and what you know about it so far.
Yeah, Lovisa is a very interesting business. I think I can speak from personal experience through my better half. I think it was a while back. I think probably 7 years ago when I first entered a Lovisa store, and it was out of wasn't out of choice, but it was a very nice store when you first go in and you see all these jewelry pieces like you have that on the screen. And they're really focused on selling three important features of these jewelry products. They're really trying to sell quality, affordable, and on-trend jewelry and fast fashion. So fast fashion, what is that? You probably you're younger than me, Owen, so you probably have a better idea of what fast fashion is.
Yeah, well, I guess I'm not much younger than you, so I mean, I probably look about 5 years older than you too, mate, at this rate. But yeah, fast fashion, right? Like it's more like things that you would spend less amount of money on, and if it broke, like say if you got a set of earrings and they broke, you wouldn't bother to repair them, right? That's kind of like fast fashion. Like it's cheaper,
Yeah.
it's a bit more affordable.
Yeah. Exactly. So that's why a lot of their products are priced between $7 to $50, mainly because fashion goes in and out quite quickly. And especially, I think over the last 5 to 10 years, I've seen the rapid shift in the pace of trends changing. I mean, what was cool 2 weeks ago isn't cool now, based on social media. I think social media and the internet has played a big role in that. But yeah, so Lovisa targets the customer demographic of 25 to 45-year-old females. So you think of, people who just started working as professionals. They might walk into a store and they might need some, jewelry pieces for a networking event, or maybe to go out, with friends for a special night out. You can, go into a Lovisa store, and they're all located in very high traffic spots. I'm not sure about Melbourne. I haven't been to one over there, but in Sydney, there's quite a few of them placed in the heart of the city.
Yeah, I find that they're, from what I know, at least in Melbourne's outer east, they seem to be more so in the areas like of shopping centres where it's like a little nook in the mall there, where
Mm.
maybe the rents aren't as high for that awkward space that an other retailer couldn't fit into. So, am I right in? I think from my research, I realized that stores are around about 50 square meters or less, um, whereas say like Harvey Norman could be hundreds of square meters. So to put that in context, it seems like the stores are a lot smaller and they fit a lot more into that space.
Yeah, so they all have the same layout, that 50 square meter layout, and all the products are arranged in a similar fashion. And yeah, they're in those small kind of places where I think people often walk past on the way to work or the train station. I I've noticed a few at Town Hall Station, which is like um, in the heart of Sydney CBD. So and that goes to Levisa's strategy of not spending money on mass marketing, and they're really relying on putting their stores in high foot traffic areas to really enhance their brand. So, which
Mm.
is something I like, because I tend to shy away from companies where they're trying to compete on getting eyeballs through spending a lot of money and capital on marketing.
We've seen that a lot recently, haven't we? Like a lot of the companies that are just have like gouged on low interest rates and really cheap capital markets have just thrown that into marketing to juice their revenue line, which for a lot of investors has pushed up the share price over the past few years. But now it's
Mm.
kind of like a reversal of that, where people are saying, well, hey, you're spending $50 million a year on marketing and you're making a loss of $30 million a year. Like we can't keep funding your growth. And it's interesting because I think the number, I could be mistaken, but I think they're tracking it around about 100 new items per day, per week into a store, if I'm not mistaken. Is that right, Raymond? Where they're basically, because they're vertically integrated, and this is where we get to like the secret sauce of the business.
Mm.
They can offer design, manufacturing, warehousing, and distribution all in house, which enables them to keep costs low there as well. So on the supply side, they've also got lower costs than a typical retail that might rely on third party logistics and so on and so forth. So I think that's another, like on the supply side, if we talk about an advantage, they've got one there as well.
Yeah, it's pretty impressive that I think they take 8 to 10 weeks to actually design the jewelry and the latest range. So it takes 8 to 10 weeks from start to finish. They design it, and they get it manufactured and supplied through China, I think Thailand, and also India.
Mhm.
And then they store the stock in Hong Kong and Melbourne in Australia, and they're the two main distribution centers. So yeah, they essentially have a lot of power and control the moving pieces of supply, which is very important for a retailer because they're susceptible to costs like that.
Yeah, it's interesting because they have actually done a tremendous job of making tactical acquisitions along the way. So maybe I guess some context for listeners is that the origin story is also quite fascinating because of Brett Blundy, who's the chairman. His backstory, Shane Falshear, who's since left the business in late 2021, I think, if I'm
Yeah.
not mistaken. And so the business has actually done a great job of making really, really shrewd acquisitions that give them a footprint at a lower risk than maybe organic expansion, just say investing heavily in, hey, we're going into Europe now. Um, I don't know, maybe if it's worth explaining, I guess, the Diva connection. I think that might be worth looking at.
Yeah, so Lovisa was actually founded in 2010 by the people that you mentioned. Brett Blundy through his private investment firm called BB Retail Capital. Um, so, um, so BB Retail Capital actually invested in very well-known brands that are probably close to our hearts in our generation. So
Yep.
businesses like Sanity Entertainment. I'm not sure if you remember trying to be cool with the headphones and listening to a couple of the soundtracks here and there.
I'm still trying, mate. I'm still trying.
Other brands include Adair's Dusk, which we covered
Hmm.
in the Rask Invest service,
Hmm.
as well as Rise and things. So Brett Blundy's got a stellar track record with retail and a really in-depth experience. But at the same time, in that period, when Lovisa was founded, BB Retail Capital was actually also invested and also managing a company called Diva. And Diva was much more focused on the younger demographic, so the kids to early teens demographic.
Mm.
So it was very different to Lovisa. At the time, Lovisa was still quite young because it was founded in 2010. But Diva was interesting because it was started by a husband and wife operation back in 2003. So Colette and Mark Heyman, and they quickly grew the number of stores across Australia and New Zealand. I think it got to a point where they had 176 stores in 2010. So that coincides with when Lovisa was founded.
Hmm.
But Diva actually ran into some difficulties and challenges. So around October 2011, it copped a lot of negative media backlash where management decided to roll out a Playboy branded accessory line um,
Mm.
targeted at younger girls. And naturally, parents, weren't happy with that and expressed their concerns over media. And yeah, they got really bad feedback about that.
Yeah, it's an interesting one because this, I guess, was at the time, Diva was such a interesting business, and so many people knew it, by name, even if they didn't have younger girls in their family or sisters or whatever. People knew it,
Mm.
and um, it was a really like sublime. I guess acquisition for Brett Blundy and to change them into Lovisa. And we saw this play out later on as well. We've seen this play out during COVID, so about 10 years later. They made the acquisition of Beeline. Beeline was a European fashion retailer, and they bought the business with over 100 stores. What was it for, like 60 or 70 euros?
Yeah,
And
€70.
70 euros. So that's not like there's no missing numbers there. That is the actual number. And the reason why Lovisa was able to do this, at least from my understanding so far, is that basically the owners of the business, Beeline in Europe, effectively just wanted to keep the business afloat and they didn't want to let go of people. So they found a buyer, which was Lovisa at the time, who was looking to expand in Europe. And here's Lovisa basically just propping up their balance sheet and converting them all to Lovisa stores, willing to take that on. I think this is like, so we see like, we talked before about on the marketing side, and maybe I'll just quickly bring up the most recent financial statements here for those people that are watching. But the business has a quite clean financial set of financial statements. So there's no debt, there's lots of cash, and gross profit margins, return on invested capital have all been extremely positive. And so basically, Lovisa was in a position where it could take on Beeline and not really have to worry about COVID and all those impacts because it was in a sound financial position, had good management who saw an opportunity to take a hold of this thing. And we talked earlier about on the, I guess, the demand side, keeping costs low, being in high foot traffic areas with low stores, so meaning lower leases, lower cost leases. And then on the supply side, being vertically integrated, that enables it to have really high returns on invested capital when it reinvests back into the business. But then also being able to make strategic acquisitions. It's rare that I guess you find both of those in one company, and particularly a retail company where it's basically a graveyard of a lot of ambitious CEOs and boards of directors. We've got some really interesting, I guess, source material for these. There's a Growth with Value is a website that you can check out that's covered Lovisa, which Raymond shared with me. There was a great report on that. So if you do want to kind of a bit more of a backstory, the report was written in, I think, 2020, but fantastic report from the author on that. Mate, I think one of the things that people always think of when they're talking about retail is basically like competition. What's stopping a competitor from doing exactly what Lovisa is doing or has done? Maybe we can talk to them for a little while. I was interested when I was running it through my checklist. I was actually interested to know that many of the competitors that Lovisa has around the world have been basically run into the ground. So there's this one in Europe. It's called Claire's, and it also has a business in the United States that it filed for bankruptcy, and then within 3 years it was trying to IPO, and this was like last year or something. But it has $500 million of debt and $400 million in derivative liabilities. And then we've got, I guess, a bunch of other names which you just mentioned, like Diva. So many others have gone into liquidation here in Australia. Yet Lovisa's kind of held strong. I guess let's just talk. Maybe we can just riff on competitors for a bit, mate. I've got Pandora as one competitor, and then you've got the big fashion retailers like Zara, maybe even Sportsgirl. Offers some accessories.
H&M.
H&M, yeah. But these Mimco, but Mimco is probably at the higher end. Like I remember seeing some purses from them about $100 versus that's a lot more than what you'd pay for anything from Lovisa. So I guess how do you assess the competitive environment so far? I know you're still going with your research, but how have you thought about that?
Yeah, the competition when I first looked into a few of those competitors, when you actually look at Claire's stores, we'll start off with Claire's. You'll see the shop front of the store. It's all purple and it's got a lot of stuff going on. Like it doesn't purely focus on selling jewelry. And if you actually go through the whole product line, it sells a lot of different things like toys there. They even sell, photo frames and home accessories, stationery. But it's very different kind of customer demographic. It's much more targeted at kids to early teens. And if you actually Google Claire's and then go to images, you'll see a lot of shop fronts. And because they've been around for so long, a lot of those stores are actually quite aged. And you see the fit out is quite similar to perhaps like a reject shop where you put the steel tilts in the back, and then you put the products on, and you've got the sticker price tags. You see a few of them have been refurbished though, and are probably newer. But I think when you see Claire's, there's a lot of different products. So whereas Lovisa is quite focused with their product range and their core focus.
Lovisa, just looking at it, Lovisa reminds me more of like a higher end. It's sure they've cramped stuff in, but it reminds me more of a higher end jewelry business. Whereas Claire's looks more like you said, like reject shop, kind of like maybe like a premier investment Smiggle type store. It's colorful, it's purple. If I'm like put myself in the shoes of say a 20-year-old female or a 25-year-old female, I don't want to go into a store that looks like Smiggle, a nice pair of earrings that I'm going to wear out tonight for dinner, So I think that plays a big role in, I guess, the experience of a Lovisa store too. And I've actually come across people and through acquaintances come across people who work for Lovisa, and they talk about how much pride they take in their store, and if they're like the manager on duty, how important to make sure everything looks really nice, so it's inviting for people to come in. The stock is available. There's no one needs to ask, do you have this in stock? You can see it on the store, up on the shelf. And so I think that plays a big part in it. How about one that I thought was probably the chief competitor is probably Pandora. Pandora being a global behemoth, it's listed on the Danish stock exchange, and it is a business that is, I think, about $9 billion Australian equivalent in terms of market cap versus 1.2, 1.3 for Lovisa. It's a business that has a pretty sizable share of the Australian market. I think it's got a bigger share of the jewelry kind of vertical here in Australia, and it's also got, I think, well over 1,000 stores. I've got my numbers here in my checklist. I think it's got quite a few thousand around the world, right?
It's got a very strong global presence. I think what brought Pandora to fame was the infamous charms that you can buy on the bracelets, and now you can get Disney or Marvel charms. And they're quite expensive when you look at the prices. They range from $150 to $200. The brand new items. So yeah, I think I probably differ a bit in terms of my opinion on Pandora's being a prime competitor against Lovisa, mainly because the value proposition or the product range is slightly different. I think Lovisa is more targeted at the more affordable and more cheaper products compared to the fancier Pandora products. Yeah,
that's very fair. And I think Pandora is probably more so, can we look like Tiffany and take some of their market share?
Sure.
And we've seen that recently in Australia. We've seen Pandora and Lovisa, the two kind of standouts in their prime target audience. They've been the two that have kind of taken the wheel and taken share. That's been reflected in both like the growing same store sales or comparable store sales, but also overall revenue growth. I'm not sure if you got a chance to check. Did you check? I guess the digital side of Lovisa, because like competitors do emerge through e-commerce these days. Like we talk about, Amazon offering these things. Did you read much into that, or?
No, I haven't. I haven't had the chance to look at the website traffic stats, which is always very insightful.
Yeah, I had a quick look today just before jumping on the show, and Lovisa is a lot smaller than say Proud's jewelry business here in Australia. A lot smaller than Proud's, but it's also a little bit smaller than the Pandora website. And the reason that I bring this up is that Pandora is a business that is global and has done a pretty good job of having a presence in digital. So I think that's worth talking about, is kind of like, why would Lovisa still be relevant in 3 or 5 years when Amazon and all of these other digital businesses are knocking on their door? And I think it comes back to, in some part, the experience that you get from going to a Pandora or a Lovisa store. It's probably different than going to an Amazon store or something like that. So
Mm.
here we can see, I've just got the traffic stats up for the last month here in Australia. We can see that and for those of you that aren't watching this, they've just got this SimilarWeb website up. That's similarweb.com. You can compare website traffics and analytics. And here we can see that Pandora's Australian website, it's about 822,000 hits a month versus Lovisa's 523,000. The rest of it's pretty comparable. But the reason I bring this up, mate, is that I messaged you before the show today, and I said, "Hey, do you know how much Lovisa is making from its digital efforts, its online store?" And the answer was neither of us could work it out because management don't disclose that. So I think, when we talk about that being a risk, sure, but maybe it's also an opportunity. They're reporting that, they're telling us that sales are going up and quite quickly, but we just don't know how much in terms of sales is going through the site versus going into store. I'd imagine it's quite small. Management have hinted at it being in its infancy.
Mm.
So I guess it's something to watch if you're an investor, like watching if management do start to report on, hey, this is how much we're uh, getting in online sales. I mean, I think it's going to be small, but it's something to keep in mind.
Yeah, I think it's also important to mention the piercing services that Lovisa provides as well. I
Mm.
don't think Pandora offers that because there's much more earrings and um, body piercing products as well on Lovisa. So I think that's a point of differentiation that Lovisa has, and that kind of sways people to go in store instead of shopping purely online.
Yeah, for sure. I think that's a very fair point. Like, there's a reason for people to be in store, and I know that there's this whole thing about, um, in I guess we had this with cinema 5 years ago, where people that was investors were saying, the cinema is dead, the cinema has gone, and for all intents and purposes, it could still go. We don't necessarily know if
Mm.
um, people are still going to be going to cinemas to watch a movie in 3 or 5 years. But I think it's much like a restaurant, right? I think we don't go to a restaurant necessarily for sustenance. We go to a restaurant for the experience. And I think it's very much the same with the cinema. You go to the cinema because it's an experience. And I think the more that retailers can focus on the experience of the store, the better they'll be. And I think Lovisa, more so than many others, have done a pretty good job of this. Of course,
Mm.
if people aren't going to shopping malls, if Westfield isn't opening its stores, then it's an issue. But like you said, you can have them at train stations, you can have them basically anywhere, and people will get that similar experience, which is kind of cool. Mate, maybe just for the sake of time, I could take you through my checklist, and you might be able to just give me some feedback on it. I won't necessarily go through the whole thing end to end, because if I did, we'd probably be here for a while. But I worked the company through my checklist, and just to save people the hassle of like how well did it do, I ultimately gave it a score of 57.5. And to put that context around that, this measures business quality. That's what I try and do with my checklist. And Magellan Financial Group got a 65.5. ARB, which is the Australian Bull Bars business, got a 69, and Zero got a 75. So this is measuring business quality. There are a few points where I guess Lovisa fell short, and that's maybe not necessarily a reflection of Lovisa. Maybe it's more a reflection of the way that I choose to invest. But we can see here that on the screen in front of you, and I'll just run through it quickly. I'll give you the high level summary. I feel like Lovisa has a really strong set of financials. I haven't necessarily done heaps and heaps of digging into various metrics like days working capital and all these different types of working capital metrics, which are really important for retailers. But one of the things that I did notice is that working capital is quite comparable between Pandora and Lovisa. So there was nothing like glaringly obvious standing out there. And that would make sense because fast fashion is all about turning things over. I know you've had a quick chance to look at my my scores for the company. I don't know if anything jumped out to you, mate, but I guess the one thing for me is the big ticket for me is how well can this business scale? In the past, we saw operating leverage, just rocket. We saw the business's sales go way up with its payback on stores between 8 and 12 months. It could just roll out stores, get that paid back, and then they were growing at like 5 or 6% per year in terms of same store sales. So you were having this huge ROI, just revenue falling straight to the bottom line. I gave it a 2 out of 4 for this metric because I'm not sure as they expand into Europe and the USA if that's going to be more difficult. There's a
Mm.
graveyard, particularly in the United States. I don't know if you have an opinion on that.
Yeah, I think that's a big question here with Lovisa, is whether it's capable of replicating its success across Europe and the US. And I think if you really um, review it under the bonnet of what management have been saying and what they're planning on doing with their rollout strategy and remaining disciplined with ensuring they secure really highly valuable sites, and sticking to their value proposition and not veering away from their core offering of jewelries, cheap jewelries that are quality. I think that is a strong sign that they could, be the success story that others were unable to
Mm,
fulfill. And I think the biggest concerns and the biggest red flags with retailers, especially when they're going through that growth phase, is really expanding across different product segments and also just really growing really quickly, quicker than they can manage. And I think Levese is in a different position because Brett Blundy, he's had a lot of experience in retail. He knows what works and what doesn't. And I think the management team have gone through with that, especially with Diva. So I think that balanced approach and disciplined approach with capital allocation really provides them with provides me with confidence in them being
mm.
able to execute.
Yeah, remember you and I did that podcast. It was probably 6 months ago now, where we talked about culture. We talked about culture killers. I think was the
Mm,
title of the Australian Investors Podcast episode. And in that episode, we talked about how we pulled up HR scores and HR reviews of companies. I was fascinated when I did run it through my checklist that um, Lovisa's scores on Glassdoor.com were the worst of any of the fast fashion retailers that I could come across, but also all of like the vanilla retailers as well. It was 2.7 out of 5, and that's with a sample size of about 500
mm,
employees. Sorry, 900 employees it was in the end. So, this is not like a small sample where some of the competitors were getting 4 out of 5, 3.8 out of 5. And so for me, I was a bit, I guess I was a bit surprised by that. But I remembered an anecdote when I was speaking to a duty manager at a Lovisa store who basically said, it's a fast pace. You work hard when you're at Lovisa. Like there's no place to like sit and rest in the back of the store because all of the space is used for people to actually do things with the inventory and like for it to be shelf space and for employees to, you know, organize the store. So there's no space for you to like sit down, have a
mm,
cup of tea, chat with your colleagues or anything like that. So I think that's probably a valid thing as well. So I gave that a 1 out of 3,
mm.
but I gave like the alignment like a 4 out of 4 because for Australian retail, Solomon Lew from Premier Investments is probably the other one that stands out in Australian retail. I read an article earlier today that basically said that Brett Blundy, who is often described as the retail king or the retail entrepreneur, um, it seems to make sense because he's done a very, very good job with staying in control of this business, powering returns on capital, providing dividends, compounding earnings. Like it's a pretty good history of execution from management, I think you could say.
Yeah, yeah, just on the point about culture, I think that's a very interesting point. I think when you view the employees of a retail company, like every single retail company, and I can empathize, having worked at Myer back in my younger days. It's a it's a tiring job. You're walking, you're standing all day, and your feet are hurting, and you might
Mm.
get some customer complaints every now and then. Um, Screaming children in the kids department as well doesn't help the
Yeah.
cause. And yeah, I can understand why there would be a lot of negative reviews, if a majority of them are at that level of sales assistants or sales staff. But I think the key employees here with Lovisa would be the product designers, because they do a tremendous job
Mm.
in ensuring that they stay up to date with the latest fashion trends. And these product designers, I think it's a team of 20, so there's not many. And I think most of the fulfilling and the most interesting jobs probably are done in that department.
Mm.
And so I think it's just to be wary about, not looking too much into, the Glassdoor ratings, and actually really understand who are the key employees making the difference for Lovisa.
Yeah, I think that you make a really good point there, and that's something we did bring up in that podcast last time. Is even though I say like the culture wasn't quite there, it's we've got to understand who's who in the zoo of this in this business, and if this is people in the warehouse giving reviews because something's happened at work and they're critical of that, or they're disgruntled, that can skew the results. They can go pretty sour pretty quickly. And whereas to say if it's the CEO that's left or the CEO's leaving a review, I'm pretty sure Glassdoor doesn't weight those scores differently. So it's important to recognize that, yeah, I mean, we often see this with other companies too, like common threads where, um, there may be a team of people that are let go. And in that case, it happens to be that there was a reason for that redundancy, but employees weren't happy about it. And that's fair, but it's also, it's probably not indicative of the entire business. So I think that's a good point you bring up there, mate. I guess so. One of the things that, if I just switch back to my checklist here, one of the things that we often look at is basically mission critical businesses or really high quality businesses where people can, I guess, where businesses can get ingrained or inside the workflows of their customers. And here we can see I've given it a score of 2 for being easy to understand, but I've given it a score of 0 for is it mission critical. Now, I'm sure if I was someone who was in Lovisa's target demographic and I was going out every weekend, I would probably say maybe this is some sort of mission critical jewelry or something like that. But for the most part, Lovisa's products are fungible. And this is a business, in my opinion, that kind of needs those designers to design and to be ahead of the trend, to be on the trend, but not ahead of it. And what I mean by that is, like, say if you go to Tiffany and you spend thousands of dollars on a product, do you want that product to be the right product for not just now, but for the next year, for the next few years, probably? Whereas Lovisa can basically say, we're not going to be the one who maybe creates that new trend, but we'll find it really quick and we'll replicate it and we'll do it for $10 or $20. Whereas to say thousands for something at Tiffany. And I think, that's where the competitive advantage lies. It's basically in the how quick can we get a good product to someone cheaply. And I think to your point earlier on, it's like when companies try and be something that they're not, that's probably when the big issue arises. If they tried to make something that was really expensive, for example, well, people might not want that.
Mm.
People not from Lovisa anyway, they might go across the road to Mimco or something like that. So, I mean, I've scored it pretty highly for the products, but for me, it's not a business that has any type of kind of like mission critical, high value to low cost input ratio, something like that. Um, Similarly, for customers, I couldn't really ascertain a lot from the customer loyalty. I think this may come back to the fungibility of products. You can swap a necklace from Lovisa out with something from somewhere else. Sure, it might not be as good, but you could probably get by with that. I don't know if you would disagree with this point for me, mate, which is that it doesn't have, at least clearly demonstrated, customer loyalty.
Yeah, I don't think it has much of a brand loyalty, because it produces so many different kind of products. It's not the same kind of brand value that you get through Tiffany and Co. I do think perhaps the brand comes from knowing, like, you buy what you get, and it's like going to Macca's and you know what to expect. And it's a similar thing with Lovisa, and I think the convenience of it, like you know what you
Mm,
get, and then say you don't have jewelry for a networking event that you got invited to a friend's party, and then you can just go in store. So it's kind of tailored for those situations.
mm.
Um, but yeah, it doesn't have the. I don't think it has the same recurring revenue that you expect from other higher quality businesses, like say
We've
Pro
seen a
Medicus.
lot, yeah, like Pro Medicus. We've seen a lot of retailers um, try and like build this. So we saw when you and I and Catherine, we looked at Dusk, which is the candle retailer. They try so hard to get you on their loyalty list and on their mailing list for discounts and so on. Mecca does the same thing. Adore Beauty does the same thing. Many of these e-commerce retailers are trying to get you to be loyal and to
Mm,
have that, I guess, that presence of mind. So you become less price conscious and you become more like brand focused in your decision making. Whereas I couldn't really find, like, even on the website when I was surfing around, I couldn't really find like a really strong emphasis on, hey, let's join the mailing list, let's follow the visa here or there. Maybe I'm mistaken, maybe I need to do a bit more research, but I didn't really find that. So maybe that's an opportunity for to build some of that customer loyalty. I don't know how well it will work. That's probably for people smarter than me to figure out. But for me, yeah, it doesn't really have that loyalty, and it probably doesn't have the pricing power. Instead, it has the cost advantage,
mm,
which we talked about before. So my checklist scores for pricing power, which, yeah, it doesn't lend itself very well to what Lovisa is doing.
mm.
Um, Maybe before we kind of wrap up the show, I think maybe the key area of focus for us just on the end here should be the competitive advantage. Where do you think Lovisa's moat lies, if at all?
I think it actually is management strategy because they've been able to secure really good locations, um, and they've been patient with how they approach the rollout strategy. They've committed to entering a territory, at least one territory per year, based on their prospectus back in 2014,
Mm,
and they've stuck to that strategy. I think they tried to roll out across Spain, and they realized that it wasn't working, so they pulled that back. Um, they run similar pilot programs with UK and South Africa, and they managed to do that really well. So I think the competitive advantage actually lies with the management's discipline, cost allocation, and also the locations of the stores. So
mm,
once you secure a really good location, I think it's hard for new competitors to actually do that. And you have BB Retail Capital, which is also invested in the large format property, I think.
mm.
And so I think management do have those connections where they can strike good leases because BB Retail Capital actually manages and negotiates all the leases for Lovisa.
Oh, right, I didn't know that. Okay.
Yeah.
Ah. Yeah, I saw some comments on the most recent analyst transcript, which were basically asking, do you have you seen any kind of flexibility with leases because of everything going on in the economy? Which, by the way, I should probably add is actually a risk too. Like, they have lots of leases, which is, if you go into the accounts, you adjust for that in your models and whatever. But I also should make note that while we're on the topic of the economy, the inflation issues, whether that flows through to raw costs or to labor. There was a note about that basically in the most recent half year saying, yeah, we've noted them, and that's maybe explaining some of the pressure that we're seeing at the gross margin level as well. But also, they rely on air freight, but we've seen around the world the cost of freight is going up. We've seen delays from major places in and around the world. There was actually an interesting comment on that in the recent half year around about 50% of their inventory, I believe, and you could correct me on this if you know it, flows through their Poland and China-based distribution centers. So rather than predominantly through Australia or Melbourne, where it was in the past, there's now more flowing through those markets, those warehouses, as the business gets bigger outside of Australia. I think the ways that we could measure whether the business is still executing, to your point about management, is how is the return on capital looking? Like, once you adjust for that, you want to adjust for COVID and whatever. We saw in SelfWealth just before that, return on capital is traditionally, up in the high teens or in the 20s, which is a really, really high return on invested capital for a retailer, but not dissimilar to Pandora. I might like their economics are pretty special too, and that their share count's been dropping and so on and so forth. So that's maybe one thing that we could monitor over time. But the other thing, I guess, to be mindful of too is, I guess, is the business willing to pull back from key markets overseas if they're not executing? I couldn't find anything on, say, like the payback period for US stores, the payback period for European stores. I think they pulled out of Spain, which was which was interesting, and that shows maybe discipline there. But I guess those are some things where we could judge management's execution if that is their competitive advantage. There's also a special note here to a Joe Aston article written in the AFR that basically highlighted Herrera's, who's the new CEO, is stood to earn something like $68 million in incentives over 3 years if he achieved an EBIT target. And you called this out separately before we came on air today, as they changed the goalpost. Lovisa changed the goalpost. They went from compounded earnings per share to an absolute number, which includes like EBIT, like just so. Maybe I'll let you unwind that, like why that's an interesting change. Why is it interesting to go from earnings per share to an absolute figure for operating profit?
Yeah, so back in FY20 in the annual report, you'll notice that they had a long-term incentive arrangement where key management personnel's goals were linked to trying to achieve a certain compound annual growth rate. And it had different tiers. So I think the lowest was probably maybe 10% per annum, and then it slowly was like 12%, 14, 16%, and depending on how much growth they were able to achieve, then management were entitled to receive performance options through that. But after FY20, naturally, FY20 was a particularly hard year, and FY21 because of the pandemic. But they decide, perhaps through a lot of discussions and deliberations, I think maybe management were feeling it was unfair, and they settled on changing it to an absolute figure, as you alluded to, based on earnings before interest and tax. And that's an absolute amount, so which is very different, because earnings per share compared to an absolute amount, I think it's easier to achieve. There's less moving parts, I think, with an absolute figure compared to a percentage amount.
And it's interesting because I just brought the forecasts up there for, say, Ebitda Forecast from analysts. This is consensus from Refinitiv, pushed through from SelfWealth. And if I just jump back into the forecast real quick, they got an Ebitda forecast. This is current consensus for 2023 of 164 million. And so if we take out the DNA on that, if we're looking at, say, 140, 150 million in EBIT, and management's hurdles, something like that, really all they have to do is get close to or just slightly beat consensus to really earn a significant lick of those performance rights, right? And interestingly, in the past, Lovisa's faced some issues with its AGMs because people have voted against the REM report, the remuneration report, because there were times there where you could measure it in double digits, like between 10 and 20%, the amount of, income that the board of directors or senior management were earning relative to the profit the business produced as a whole. So you're probably thinking, well, that's a lot to pay back to these executives. But I guess the reason that they can do that is they've got a founder who's the chair who owns a lot of stock in the company, has significant sway with voting rights.
I think it's
And at the end,
40%.
yeah, so yeah, over 40%. So I guess it makes sense. Like at an AGM, if he's the only one that turns up in person, or there's only a few other people there, he's got a pretty good vote. So this is, I guess, the thing is, if you invest in a business where there is over 30% insider ownership, you have to kind of be realistic. It's probably it's probably what the founder says goes, and I think the fortunate point of this is Brett Blundy has a tremendous track record and has, across all measures, basically done the right thing. Where it would become an issue with the earnings per share versus absolute EBIT figure is if they started making heaps and heaps of acquisitions, because then that could just destroy value, and you could end up like Claire's or insert other retailer name who went into bankruptcy. So I think, but at the same time, Brett Blundy's probably not going to let that happen because he owns so much of the business, right? So he's probably not going to let that happen. So I think that's a something that people have to be mindful as well, is that the executives might get paid a fair bit. I actually took 2 points off my score for that just because they were paid a lot. It was a bit of it seemed like the yardstick for earning so much in incentives was quite low, or at least it was like pretty generous. Maybe, Victor is a tremendous operator and he delivers overseas. If that's the case, then shareholders will be laughing all the way to the bank. So, yeah, I think, we've been through everything. I think that the thing that we haven't really talked about, mate, is basically valuation. Shares have come a long way back. The business offers a dividend yield, fully franked, I believe. I could be mistaken on that. I think it's fully franked. So, a yield of around about 4% in terms of dividends, price earnings ratio of 35 times. But if it cycles out and gets some operating leverage in Europe and the US, that could be good. It's free cash flow positive, even though it's paying a big dividend and it's reinvesting. I think it's, in terms of, if I compare the revenue to the CapEx, it's probably in the teens in terms of how much it's still investing in the business. It's got a lot of leases on the balance sheet, which you'd expect. So it's a business that current market cap around about 1.4 billion. It doesn't come super cheap, but it's a business that is a proven compounder. So, and there's still work to be done for both of us. I think you're going to do a write-up for your blog later this month, perhaps. Or maybe if you share that on Twitter, I can give it a bit of a push around. But I think it's fascinating business, mate. I think it's fascinating. Did you like researching it?
Yeah, it was a very interesting business. I think it's always good to research something that's usually, outside of my, flywheel, in that it's on the female side of things. And I think
Yep.
it's a good opportunity because I think investing is a very male-dominated industry. So it's always great to look at, things that the majority of the population might not really look at because of their personal experiences.
Yeah, like I've never personally bought anything for myself from Lovisa, but I know my partner and friends definitely have, and I always go past and it's busy. It's kind of like Pandora and Lovisa are very busy, and everything else is pretty quiet. That tends to be the way that it is. And if you follow the crowd, you might find that there's a reason to get excited about it. And I think there's a lot of reasons to like Lovisa. It's not a stock that I own. Do you own it? I probably should
No,
have asked
I
that top
don't.
of the show. Yeah, no, me neither. So it's definitely one that I'm going to put on my watch list and keep going. I think there are some areas that I need to know a bit more about, and particularly I want to get a better handle of like the economics in the United States, because during COVID the economics worsened, obviously. So I want to find out about that. Try and get a handle on how much they're actually making from per store in the United States and Europe would be great. And then also just seeing the competitive landscape evolve, how they are going to build loyalty or not. I think that's really important too. Raymond Jang, you're on Twitter, mate. You've got is it rjang_? I think
Yeah, that's right.
That's the Twitter handle. You can reach Raymond there, and you can reach me on Twitter at Owen Rask. All the links are in the show notes, so jump on there and click. Say g'day. Let us know if you want to do another one of these episodes. If you want us to do another one of these episodes on a company of your choosing, there are so many great companies out there which we can dig into, and we're more than happy to. So, Raymond, on behalf of myself and everyone listening on the Australian Investors Podcast, thanks for joining me.
Yeah, thanks for having me on, Owen.